Good morning to those joining across the Europe and the UK. Welcome to day 3 of Armstrong Wolf Conduct and Culture Summit 221 Purpose Over Profit. I'm Maurice Devlin Bufton, I'm the CEO of Armstrong Wolf. Over the last 3 days, we have investigated, dissected and debated various aspects in relation to developing culture, purpose, and then on the day 3, we're looking around the ever-present challenge of controls and governance, and particularly in context to that, the role of the Chief Operating Officer and the Chief Control Officer First Line Defence. Today, I'm delighted to have an excellent panel representing many different continents and many different companies, and I'll be introducing them very shortly. Just a bit of background of where we've got to on this journey, particularly around the first line of defence, started around about 2014-15 for myself when I hosted the first Chief Control Officer roundtable dinner. There were 6 Chief Control Officers there then. Now when we gather, there's somewhere around about 35 to 40. Throughout that whole period, it doesn't matter what we've debated, at any time, every quarter, sometime during that conversation, the ever-present challenge and potential areas of increasing, let's say, not necessarily conflict, but concern has been the definition of line of responsibilities, the duplication between first line and second line. This led in January to Armstrong Wolf partnering with FTI Consulting, and then we've undertaken a market-wide, 30 bank-wide review of the 3 lines of defence. We're halfway through this now, and today I'm delighted to actually have this conversation being led by the esteemed partnership of Simon Longdon from Armstrong Wolf and Nigel Webb, that they're going to introduce themselves. But I'm actually going to now pass to Simon to introduce himself and on to Nigel. And then Simon, if you can introduce the panel as well. Thank you very much for attending today. This is a key and central debate and something that we are determined to help the industry address to the benefit of all. Simon.
Yeah, thanks, Maurice. Good morning to everybody in Europe and good afternoon or good evening to those in Asia or Australia. My name's Simon Longdon. I'm a partner at Armstrong Wolf. Prior to that, 35 years banking experience across the city with Standard Chartered and across Asia, Africa and the Middle East. Nigel, sir.
Good morning to everybody as well. Nigel Webb. I'm a partner at FTI Consulting. I lead our EMEA financial services practice. That's a practice which primarily is associated with working typically with regulators, either in investigations or enforcement actions relating to banks. But for our sins, we also become involved where banks are looking for assistance when they find themselves under the spotlight. So real pleasure to have worked with Simon and colleagues over the last few months on this, and we're looking forward to a good discussion today.
Thanks, Nigel. Jason, sir. You there, Jason?
I am, yeah. Yeah, hi, it's Jason Hope here. I'm calling in from Sydney, where I am the first line head of risk for the institutional business at Westpac. Previously, I actually moved to Australia from the UK in January. Previously been in the UK 26 years in second and first line roles. Primarily at UBS for 21 years, a couple of years at Deutsche Bank, and then the last 3 years at HSBC, running the Chief Controls Office for Global Banking and Markets in Europe and Global Risk Governance.
Thank you, Jason. David.
Thanks, Simon. Good to be here, and thank you, Maurice, again for the invitation. David Scherer. I am the China COO for Commerzbank. Few grey hairs, so it's been about 27, 28 years, I think, in the industry, various countries, US, Europe, Asia. Very much looking forward to this debate. As I think, as Maurice said, it's a timely juncture and a very important topic. So thank you.
Sanjeev.
Thanks, Simon. Sanjeev, I'm a Standard Chartered. I'm based out of Singapore, look after non-financial risk for financial markets, others know it as global markets. Been in the industry for around about 28 years, worked across predominantly Goldman Sachs, Credit Suisse, a small stint, and Deutsche Bank. But this is going to be an interesting conversation. Thanks for the invite. A lot of the topics are live and being discussed at Standard Chartered at the moment. So I think it should be a good debate.
Thank you, Sanjeev. Last but not least, Christian.
Thank you, Simon. Good morning, everyone. Good afternoon. I'm coming to you live from Europe this morning. My current role is to lead global market supervision for the FIC business at Royal Bank of Canada. But prior to that, I spent around 20 years working in rates and exotic rates trading at RBS and at Merrill Lynch. Then I spent 5 years in a surveillance role, leading the surveillance effort at RBS, now NatWest. And in the last, just over a year ago, I moved into this role at RBC, which is in an interesting place, a slightly different part of the journey to my previous organization. So I'm also interested in, not just the topic of the debate, but thinking about, where each respective institution is in this journey, because we're all coming from different starting points, I think.
Thank you, Christian. I'll give a quick update on where we are in the process, but I think the panel we have here is incredibly rich experience. London, Singapore, Shanghai, and Sydney. That's testament to the breadth of reach that Maurice and the team at Armstrong Wolf have developed across the COO community. And it's a representation, a geographic representation that has contributed to the review thus far. So as Maurice said, seldom does one of the forums take place where 3LOD does not raise its head. So in response to feedback from the community at the back end of last year, we agreed to commission a piece of work to understand from the first line what the primary concerns with the model are, and rather than just complain about them, consider ways in which collectively we might be able to solve for them. As Maurice said, we partnered with Nigel and the team at FTI. They bring a unique perspective, having gone in on the back of regulatory requests, issues, or remediation, and will have great insights on where things have fallen down and not delivered effectively. So between their insights and the insights from the first line community, we've been looking to gather, real insights to what the main issues are. To date, 30 interviews have been conducted with peers across the UK, US, Canada, Europe, and Asia. Constructive, very constructive input from everyone that's participated. And you probably won't be surprised to hear that a common set of pain points have been identified. And we've clustered those into 4 main themes. And Nigel will take us through those shortly. Now, in the last few weeks, we've run a number of workshops with COOs to go through these themes that have been identified and to try and find ways to understand how we might be able to address them. Some of the participants in the interviews have engaged representation from their own second line to let them know of this review, and we've encouraged the others to do so in parallel. And FTI have been in dialogue with their own contacts across the second line to take their perspective on what the challenges are. Now, it's the intention over the coming weeks to formulate a final set of recommendations that we will then share with the first line community in advance of a roundtable that Maurice has scheduled with representation from the FCA later in June. Finally, it's not the aim just to engage the FCA, but to reach out to other regulatory and industry bodies also, and those discussions have already commenced. Nigel, do you want to take us through the observations and the key pain points that have been identified thus far on the journey?
Yes, absolutely. If I could have the next, there we go, thank you. So what I think was remarkable to us right across all of these interviews was a degree of consistency in terms of the feedback that came back. What's also interesting is that rather than there being, say, 4 or 5 distinct and entirely different pain points, there's sort of a general area of consensus in terms of where the pain is being felt. So what we've tried to do here with these 4 boxes, which I'll walk through in a moment, is to describe points of focus in that pain. And you'll see immediately as we walk through them that there's a degree of overlap between each of them. And I think that was helpful because it genuinely represents a degree of consensus that there was as we spoke to people. So I'll start in the top left because I think, as you'll hear, that's a good bit of context setting. So when people are asked, where do the 3 lines of defense come from and what are their objectives? The objectives, I think people have a pretty good intuitive understanding of. Frequently, people don't actually know the origin of the definition of 3 lines of defense. It was actually a paper originally produced by the Institute of Internal Auditors. And if you actually look at the work that's been done since that was put forward, there have been numerous variations on a theme, each of which introduce subtle differences to what was intended by those 3 lines. A particular interesting reference point is the purpose of the second line, which was originally described as being a challenge function, which implies, I guess, a certain behavior on the part of the second line in relation to the first. In fact, in more recent versions of the 3 lines of defense, that role has been softened slightly, and instead of challenge, assurance is now being put forward as the function of the second line of defense. And in fact, challenge as a role still exists, but in context of the 3rd line of defense. What does all of this mean? It means that actually, if you talk to 30 different organizations as we have, there are different takes on what the intention behind and the points of emphasis are within the 3 lines of defense. And that translates in turn in a degree of inconsistency in the way in which people view their various mandates. So again, without laboring the point, because I think we will have plenty of chance to talk this one through in detail, a fundamental understanding of the 3 lines of defense is missing, or at best inconsistent, amongst really quite substantial institutions. And you'll appreciate without that kind of underpinning, it's easy to see how things start to go wrong with differing understandings within the same institution as to what the model is attempting to achieve. If I move down then into the bottom left-hand box, you can see immediately how this flows through into the purpose of the second line. If you've been set up believing you're a challenge function, you will behave in one way. If you believe that you are merely providing assurance for the first line, then perhaps you'll behave in a slightly different way. What we have observed is increasingly the kind of advisory function that one might have expected to see within the second line has started to migrate its way through into the first line. And the terminology line 1B to describe that kind of pseudo-compliance advisory function living within the first line has started to become quite prevalent. The issue that many identified within the first line was that once you'd actually taken that advisory function out and put it into the first line, what was left and did it add much value? And there was a concern perhaps that the second line in some institutions have become more focused on testing and retesting of the first line, rather than perhaps providing the added value that perhaps some in the first line might have felt it needed. So again, and I'm being careful with my words here, no one is suggesting the second line had no function, but rather there was a feeling that it had been devalued because some of the traditional second line functions had found their way into the first. There's also, I guess, to level the playing field, a feeling that the first line had been slow to pick up on its own responsibilities. We know, I think, if there's been a trend in the 3 lines of defense, and in particular the regulatory view of them over the last few years, there has been the increased pressure to ensure that business risks are owned in the first line of defense by the business. And the consequence of that is that also many of the controls around the risks associated with the first line are also supposed to be owned by the first line of defense. The second line increasingly playing more of an assurance role. The concern has been expressed by the second line repeatedly to us that the first line has been slow to recognize that ownership. And certainly, speaking from FTI's own experience, many of the regulatory and enforcement actions we become involved in because there is concern on the part of the regulator that the first line has not stepped up to the plate and actually owned its risks. For example, when asked about financial crime risk, we've had more than one firm tell us that that's the responsibility of the MLRO, which is clearly not the best answer. Let me take you up to the third box then, top right, which is the question of inefficiencies. This was a really, really popular theme in the conversations that we had. And this arose from, again, perhaps this lack of clear distinction between first and second line responsibilities. In other words, what we found happening was that the first line was testing. I'll use the term generically for a moment, but this was in some way unacceptable to the second line of defense. The second line of defense needed to be independent and to perform frequently the same tests. So what we found was at the very best, there were two groups of people performing broadly similar, if not identical tests within both first line and second line. In the worst case, complete systems infrastructures were being evolved twice to support that kind of level of testing. So the question was driven to us on many, many occasions in the interviews. I'd probably say more than 50% of occasions, that the second and first line of defense, because of this lack of clarity, were effectively building completely inefficient, redundant architectures, both humans and systems, to support what they perceived to be the need for independent duplication of testing. I think a factor that also fell into this box was a question of trust. When people were asked in the second line of defense in particular, why was it they were going to all this effort to build duplicate infrastructure and to perform these tests? Well, the first line couldn't be trusted to do it themselves. And that lack of trust cuts both ways. It's not only that the first line couldn't be trusted, and I'm deliberately speaking directly here, but it was also the fact that when you talk to the first line about the nature of the tests being carried out in the second line were, and I pretty much quote, not close enough to the business, didn't have the right backgrounds, didn't understand what they were testing, and therefore weren't actually adding much value beyond going through the motions. So not only duplication, needless duplication, but potentially duplication that was inefficiently carried out. These were all the suggestions made to us. And that takes us inevitably to a particular hot potato, the bottom right-hand box, which is the question of the kind of levels of resource that one found within the different lines of defense. And again, in particular, there was a sharp focus on the first and second line of defense. I think we're all pretty much aware that certainly after the credit crunch, and even in recent times, there's been pressure, perceived pressure or actual from regulators for the second line to up tools and to increase the level of resource applied to it. And we saw a great deal of that right across the world. There is perhaps a sense that that peak is over and that the second line is starting to right size again now. But there is an enduring perception, particularly in the first line, that many of the controls and all of the risks have headed in their direction. The expectations have grown within the first line as to what the first line is supposed to do, but actually we're still living with a resource balance which is more reflective of effort taking place in the second line of defense. So there was an enduring and I think pretty much unanimous belief amongst the first line interviewees that the second line really was carrying more resource than it perhaps needed, or at the very least, that the first line needed more resources to pick up on the kind of challenges that had been passed to it. So summarizing the four, you can see there is a degree of overlap between all of them. The basis really seems to be a lack of consistent expectations as to what the lines of defense are meant to achieve. A concern that perhaps the regulators themselves haven't really set the standard, or indeed have defined what that standard needs to be, at the very least, not on a consistent basis. And then the various behaviors that you would expect under those circumstances, such as a degree of people both pushing responsibilities into other areas, as well as people perhaps feeling the need to duplicate in order to protect themselves. All of these things have come to pass on the back of a model which in principle should have done good, but perhaps has got to the point where it's outlived its usefulness. So there's the summary. I will mention just one last thing before passing back to Simon, because I've focused very hard on first and second line in this commentary. And it would be a fair reflection, I think, of our conversations that the first and second line got most of the airtime, but worth a few words on the third line of defense. There was, and I think for as long as I've been in banking over the last 30 odd years, a concern that the third line of defense did not have the skill set necessary to delve increasingly into the kind of complex risks and issues that there are that have arisen on the back of recent thinking. In other words, that the third line of defense still tended to perform a valuable but perhaps limited function, more box ticking than it was actually getting to the heart of individual risks and issues. And this was attributed to a combination of perhaps not having the adequate resources in terms of numbers, but also perhaps more importantly that the skill sets were not quite adequate to deal with kind of the modern risks that a financial institution might be facing. So whilst it would be wrong to overplay that, the third line was very much a secondary consideration in the interviews that we conducted. It was there as a niggle as well. Simon, what have I missed?
You haven't, Nigel. A very good summary. Thank you. Before we go into the formal questions, initial question I'm going to pose to David. You look at those themes there that Nigel's taken us through, David. Do they resonate? Are there any surprises, or is anything missing?
No, I think it's. I mean, Christian and I worked together at an institution that was, I think, particularly well controlled. And I think, certainly the benefit of my journey has been I've worked in the US, I've looked at Europe, I've been in Asia, and I think all of those 4 points resonate extremely clearly. But I do think one of the things that has come out of that journey is exactly as you say, Nigel, the perception, the acceptance, the recognition, the guidelines, the regulatory framework and application differ widely across geography, across regulator, across institution. I mean, just one sort of like anecdote. When after I left RBS, I was talking to a head of trading at another organization, and I was talking about a variety of the first line responsibilities. And the first comment that came back was, you must have worked at RBS. And I think it was a recognition that actually, a number of institutions do things at one particularly extensive level. Other institutions interpret it slightly differently, and other institutions, exactly as Nigel says, have a much higher degree of blurring between that first, second line responsibility. And I think the one thing, just saying, and I'll stop at this point, but the one thing that absolutely does resonate is that over time, I've seen my journey as a COO go from being someone who has had a second line very much as a strategic partner in terms of getting the execution and the trade done in the context of the regulatory environment at the time, to one of an advisory service, to one where it appears, I think, largely now where the first line seems to do a lot of the work, in fact, most of it, and often the second line's not particularly visible. And I'd imagine that resonates with a lot of people on this call.
Thanks, David. First question to Jason, if I may. Jason, we heard from various institutions that the respective roles and responsibilities of the first and second line are often not clearly defined. How have you articulated the respective mandates of the lines in your role? And what challenges have you faced in defining the mandates? And critically looking forward, what key principles do you think should be reinforced to further define the mandates?
Yeah, thank you. Thanks, Simon and Nigel. I think it goes to the point that was raised earlier around, different firms have different levels of maturity on the embedding of the three lines of defence. And I tend to have found that in my last two firms that are more retail focused, it's taken a lot longer, and they're a lot further away from the pin in terms of embedding at both HSBC and at Westpac than, say, the likes of a UBS, which was more of a investment banking type organisation. So I think in terms of sort of trying to reinforce the mandate, the first line management is really key. And since I joined Westpac, my CEO, myself, our chief risk officer, and our chief compliance officer have run sessions for all of our business leaders, just reinforcing the importance of the three lines of defence, saying to our business leaders very clearly that you are the owners of the risk. If something goes wrong, don't point to your compliance guy or your risk guy. You have responsibility for it. But also reinforcing that the partnership approach and the fact that we have our second line colleagues, but they ultimately they're there to both advise and to provide that independent challenge. And so very much the feedback we gave our people was, let's engage with our colleagues in the second line early. Let's bring them into a transaction or into a new product approval early, so that we can use their expertise to help structure safe and sustainable business. rather than sort of leaving it to the 11th hour and bringing your compliance folk or your risk folk in at the end of the journey when you've got a client that's ready to pull the trigger on a deal, and sort of not really providing them with a fair opportunity to do a proper review and to sort of potentially have to approve a suboptimal type transaction. So I think it's very much reinforcing reinforcing what we're using at Westpac as the sort of the rolling out of front to back process mapping and trying to provide and run our governance on a much more of a front to back view. So rather than the historical sort of siloed second line view where you look at financial crime and you look at reg compliance and all the various second line sort of disciplines, we're trying to pivot that to more of a front to back view so our business leaders can look at the client onboarding, they can look at the pre-trade, the trade execution, and the post-trade, and understand the controls that they're running at all those various phases of the journey, and the fact that they're relying on their colleagues in the second line and in a lot of instances to run those controls. So the likes of transaction monitoring will be run by financial crime, your surveillance will be run by your compliance teams, etc. And we need to build that sort of virtual partnership around a business so that if I'm a business leader and I run my business, I know who my people are that I rely on to run my controls, and if they're not operating effectively, I know who to sort of chase around the building.
I think that raises a really interesting question that we heard a few times during our interviewing, and that was the question of independence. When people were asked to justify what was happening in the second line of defence, the answer frequently was, well, this can only happen in the second line of defence because that way we guarantee independence. And it was almost as though you could not construct something that was also in the first line of defence that was seen to be independent. And this question of how do you guarantee independence was very much at the heart of why people clung on to the three lines of defence model. So we kind of put the question out there to our interviewees. Can we actually move away from the three lines of defence altogether if we can simply satisfy this test that we can create a body that's independent from the business? Good example might be product control, which many people are used to being in the first line of defence, which intuitively is independent from, say, trading functions. I wondered what you thought about that, independence as a substitute for the three lines of defence, and what standards you might need to meet in order to be independent.
Yeah. So I think, independence is, I'm in a first line function. I report directly to the CEO, and I see myself as slightly independent of the business. I'm not as independent as someone in risk or in compliance, but I see my role as I provide my CEO with some insights into proper risk management, and where I see things that don't make sense, I'll call them out. This sort of is product control in the first and second line. Maybe I'm old-fashioned, but I sort of see that as a second line function. They run a control, but I think it gets a bit confused sometimes about where people sit. I remember in HSBC, one day I spoke to someone in regulatory compliance who ran surveillance, and they told me that they sat in the first line of defence in the morning and the second line of defence in the afternoon. In terms of, I think people can sort of over-engineer that a little bit. I think anyone that sort of has an independent reporting line into a CFO, a CRO, Chief Compliance Officer, I would see as independent.
It's interesting that you raised the surveillance question, because this was another example that was used frequently. The argument when, on the one hand, surveillance has to be in the first line of defense, because only in the business have you got the kind of proximity to the technicalities of the business to understand what it is you're surveilling. And there really is very little point in some generalists trying to understand trader jargon, for example, if they're monitoring communications. On the other hand, the argument goes it can only possibly be in the second line of defense because you can't really have the first line monitoring itself where there may be market manipulation, criminal activities, or other things that may need picking up. And I think opinion was completely divided down the centre in our interviewing. I don't know whether you or any of your colleagues may have an opinion on that.
Yeah, I mean, I'll finish up and then let someone else have a turn. But I see it. You know, there's lexicons and things there that are completely independent of the business, and they need to be. So for me, surveillance is second line activity that's independent of the business, and it needs to be. As soon as you give the keys to the first line and they start sort of understanding all the lexicons and the techniques and the technology that's going on, you know, these are bright people, and they'll probably try and find ways to beat the system.
So maybe the trust point I made in my kind of preamble is an actual issue here. That ultimately the concern is you give people the keys to the bar, and they're going to go and get drunk. Is that?
Yeah, I mean, you always have the rotten apple, unfortunately. You know, the 99% of them will do the right thing, but
yeah, very good. Thank you.
Sandy, I was just going to add, I think I've always had a saying in the organization: what gets done is what's inspected, not what's expected. So there will be a conflict of interest. People will be driven, and, you know, we're expecting our traders and our sales staff to be heavily driven by performance. So, you know, supervision is one of the streams I look after for financial markets. And I would say, as long as we segregate the design of the framework, then that's fine. Like, we talk about lexicons and we talk about other things. So this thing about independence is valid, but in my head, I think about independence from a design perspective. So as long as the design is done from a control framework viewpoint and leveraging technology a lot more than kind of manual resources, which can be influenced, as long as the design is independent, I think that's the right way forward. I think there is definitely a conflict of interest, and across all the risk types, when you look at it with a conduct lens, you know, people are going to be driven by different things. And again, what I've seen across multiple organizations is people are driven by coping strategies. So where you've got really, really harsh targets, where very, very big stretch targets that are unrealistic, that have been pushed top down, that drives people to perform in a different way, because what's being inspected is obviously the revenue number. So having someone who's under a lot of pressure from corporate plans and targets, coping strategies kick in, people cut corners, I don't think those are the right individuals to be involved in designing and running control frameworks.
Thanks, Sanjeev. Christian, having heard the discussion there, you know, the alignment that an expectation that Jason's tried to drive with the business, the question around independence and segregation, can you share a perspective on, you know, what you've seen and where the major challenges are that you have faced?
Sure. Yeah, certainly. Well, I mean, firstly, just to pick up where Sanjeev was going as well. I mean, I couldn't agree more. I think we've wrestled with this for some time, the idea of independence and really perceived independence and an idea that just because something is placed in the second line, somehow it is independent and therefore, you know, more reliable, more trustworthy. You know, if not performed correctly, you've just got second line employees coming to the first line, presenting data and frankly taking their word for it because they're not in a position to challenge. So it's running the second line. Does that make it independent somehow? Versus it's running the first line, therefore we can't trust it. I mean, I have huge sympathy for the fact that, you know, particularly in certain organizations like David and I have worked at in the past, which got itself in a good place, but from a very low starting point, right? Some significant conduct risks that effectively surrendered the right to trust in the first line. And I recall at that point, you know, one thing that led from me moving out of trading and into surveillance was the observation that the first line simply didn't have a voice at one point, that the whole control environment came in and was enforced upon it. And arguably, you know, with good reason. And it took a fair amount of time for really the installation of a supervisory framework, for the culture to develop in such a way that that the ownership of and the accountability for the risk was recognised. I think about also, what Jason said about the messaging of the mandate. We go back to the literal first line of defence. I think still too many organisations talk about the first line as being producers, revenue generators, all these rather unhelpful terms that make it feel like control is someone else's problem. You said in the introduction, awful lot going on in terms of changing ideas of roles and responsibilities over time. I think it's sort of been by necessity. We've had to go back. We've had to say, right, for a time, the second line did have a huge role to play in the control environment because the first line had simply failed for some time. But little by little, and I recall early days of surveillance alerts being switched on and, dashboards lighting up like Christmas trees, and not just for misconduct, but just for lack of practice or bad habits or people just not realizing what the rules were. And little by little, you're seeing this evidence. Little by little, you're seeing more and more front office escalations. Regulators continue to report more stalls, not just in the equity world, fixed income picking up responsibility. And I do see that cultural change. I do see a recognition within the supervisory body now of what needs to be done. And so that conflict you talk about, the dual-hattedness of I'm a supervisor, therefore I've got responsibility, but I also work in the first line, so I'm motivated to look after myself. Now, I feel that those conflicts are being managed now through messaging, through culture. I think the evidence is there. And so in that respect, I'm personally being in a 1B role as well, I'm very much supportive now of where the first line has got to. And just to come back to Sanjiv's point, if the design is independent, if the challenge is there, then I think that the operation within the first line is right. And just to close, if I'm the head of trading, what makes me sleep well at night is really appointing my best people, my crack team of experts in the first line who understand the business and who are going to bring me the best information based on their knowledge. If I'm the CEO, then what helps me sleep at night is that I've got a second line function. I've got someone challenging that so that I know that what the head of trading is running is fit for purpose. And there's your balance. And I know that brings some duplication issues into play, but I think that's the sort of the two forces at work.
Question around duplication. It came through very loud and clear from all of the interviews, and a number of the firms we spoke to had gone through an exercise of the process mapping that Jason described and trying to ensure, correct understanding and accountability of who was doing what. And it put the first line into a pretty good position in terms of understanding, okay, we absolutely agree we will do A, B, and C. And when I challenge them, does that mean you have a good understanding of what the second line might now stop doing as a result of this alignment that you've introduced? They were not able to provide an answer. So the suggestion that the duplication is still there, but the second line believes the primary issue has been solved because the first line now knows what it needs to do. How have you, where you've seen duplication in your own organizations, how have you sought to assess the extent to which a duplicative task is value add versus actually take out activity, because all it's doing is increasing the cost of compliance and not delivering any real value? Jason, from the alignment you've introduced at Westpac, how have you driven that conversation with the second line?
Yeah, so I think maybe stepping back into HSBC days, when I first joined there, I was sort of gobsmacked with the number of people that were sort of testing and providing assurance across but the first, the second, and the third line. There was people tripping over themselves and people reviewing the same things sort of, 1 month after the other person had reviewed it. And so we took some pretty drastic action in the first line. Rupert Jolly, who I was working for, he was the Chief Control Officer for Global Banking and Markets, basically stopped, automated a lot of testing and then just got rid of a lot of the manual testing. And so our headcount went down from 1,100 in the first line controls group to 400. And then we sat with our colleagues in the second and the third line and said, "Now, guys, we need to sort of come up with a game plan in terms of, scheduling of reviews to make sure that we're not all looking at the same things, if not at the same time, in reasonably short proximity." And we sort of came up with a glide path where audit said, okay, well, we'll focus on this, and second line assurance and compliance would focus on something else. And that was a sort of, we came up with a slightly more productive output, and I think a bit of the duplication went away as a result of that. But there is still duplication in some areas, but I think assurance is the one that really jumps out at me, and sort of testing, and I've got quite an allergic reaction to that being done in the first line. I think the first line's job should be to set the appropriate framework up and to manage the risks appropriately, and then our colleagues in the second line should be testing, effectively assuring that, to make sure that they're comfortable that what we've set up is right, and if it's not, we fix it.
Thanks, Jason. Pose the same question, David. The question around the cost of compliance and duplication. Where have you seen that, and how have you sought to address that in the roles that you have had across the community?
Yeah, and just actually pick up on what Jason said. I mean, I've seen it from both ends, actually. I've seen it from exactly as Jason described, the people tripping over each other to ensure that they've got the controls in place, and mass duplication. And I've seen it at the other end, where actually, in the absence of any form of framework or ownership, everybody's running for the hills to avoid taking ownership of the problem. And I think the happy medium that certainly most recently I've been looking at, as it all comes from a very simple mantra, which I'm sure everybody here is equally aware of, which is regulation drives policy, policy drives procedure, procedure drives KPIs, and you use that as a continual feedback loop to get the control into the operation and the process. The reality is, and I do very much subscribe to the view that compliance is A, everybody's responsibility, and B, that the first line has a responsibility to understand the regulations which govern their business. And so I think the first thing really that we've done is we've put in place a fairly rigorous process by which any new regulation gets cascaded directly to the people that need it. And that goes through a relatively robust review process prior to any form of cascade to, relevance check. Do we actually know who should be looking at that? And then there's a governance framework around that to track the evolution and development of the response to that specific piece of regulation, such that it makes the journey from being the equivalent of regulatory technical standard or a piece of cascaded regulation into that policy, procedure, and KRA KPI. Now, that in itself is a long journey, but by careful governance of it, I think you can minimize the risk of duplication, but more importantly, you can start to put that ownership model around who actually has ownership for the design of the model and the control, who has the ownership of the testing of that, who has the ownership of the implementation, the working procedures, the policies, the procedures, and the general governance at a branch-wide level or a business-wide level for that prevailing regulation. I mean, it's a hard balance, right? Because, as I said, you have either the enthusiastic approach where everybody wants to be involved and build the controls and make sure it is built appropriately, and then you have the counter, which is everybody's running for the hills to avoid it. And I think making sure that that responsibility matrix is very clearly defined at the get-go, and the cascading governance around the regulatory framework is disseminated. That way you can at least minimize the duplication of effort.
Great, thanks, David. I'd like to shift gears a little. On a session we ran yesterday with Maurice around looking at threat and risk, we were talking about how the focus in risk meetings in many firms is very much on the here and now, as opposed to considering those emerging risks that are on the horizon. Sanjeev, from a perspective of some of those bigger risks that are out there, cyber's now there, clearly climate, ESG risk, etc. Do you think the three lines of defense model as it stands is suited to managing that, both from a design organization, but from a skill set perspective? what do you see some of the challenges that you face as you try and consider how you're going to, comply with the obligations of you now with something like ESG?
I think it's a really complex question. There's no simple answer, to be honest. I think just to kind of loop back and then thread it into this question, I think one of the things that, like David said about regulation driving policy, driving procedure, driving the work, I think that's totally right. So what we've decided to do is step up the chain and say we need to solve at a policy level and simplify policies. And what we've now developed in financial markets, one of the concepts we've come up with is a clearinghouse. And the clearinghouse sits across the second line, but the different areas of the second line. So I was finding the fraud function had duplicative policy standards as, say, the cyber team, as some of the compliance team. So we're duplicating. So that was really effective in setting up a clearinghouse and saying, has the second line really thought the design of this policy and standard through before pushing it down or pushing it out to the first line? So I thought that was something to share with this group that we found really, really effective. And it seems to be paying dividends at the moment in policy simplification. At the moment, in terms of what we call, emerging risks, horizon risk scanning, a lot of organizations do not risk rate future potential risks because they haven't happened. So a lot of organizations will look at risk and say, this is our current situation and this is our current risk level. If it's elevated, we're going to manage it and we're going to prioritize it. If it's not, let's just park it. Something that we're introducing just recently, something that I've introduced as part of a new framework, is actually doing that horizon risk scanning, but not from a socio-political ESG, because to be honest, that's so hard to predict. You can do certain work at a structural level to start preparing you for it. But the low-hanging fruit for us has been really working, for example, with the compliance function and saying, where is regulation going? Even if, and compliance will say, well, we can never say 100%. So we set a threshold to say, give me 70%. And we start saying, right, so we've, in the past, we've had SFTR, we've had things around MiFID, we've had things around EMIR, which if we'd taken a forward-looking view and said, if we don't start work today, and it's going to take us a year and a half, this risk is going to materialize in a year and a half in the future, and recognizing actually that as an elevated risk today, I think that's a healthy way of looking forward. So what we've just recently started to do is structure a horizon risk scanning, not a committee because it's not regulated, but a forum which looks forward. It's with compliance, and we sit with compliance and we talk about what regulation is coming in the next year or 2 years, which if we didn't comply with could lead to, say, business restrictions or fines. So that's what we've done. We've taken a very, very focused approach, and we haven't gone broad because a lot of that is so gray. I just thought, I don't want to get into that space. A known regulation that's up and coming, and there's always new regulation that's up and coming. So, focusing on that and how we're going to address it and getting ahead of the curve and dedicating resource and investment today to address a future risk. And that, for this organization, Standard Chartered, is a real shift in mindset. And talking to some of the colleagues across other banks, it's the same mindset in other banks as well.
Thanks, Sanjeev. It's interesting. So a common theme which came up when we were doing the interviews was one around the introduction of new policy in response to regulation, etc., and the extent to which concerns were raised that policy and everything that was then wrapped around it were completely gold-plated, and it made it almost impossible for people to comply and have the appropriate check and control processes in place. It sounds like getting in early with what you're doing in that dialogue with those horizon issues, Sanjeev, should help you mitigate an over gold plating of policy and requirements. Is that correct?
I think that's right. Like when I've kind of run conduct for a number of years as well. And when I was reviewing conduct, not only across this organization, but other organizations, a lot of the time, 50% of disciplinaries were policy breaches. Now, I'm sure people aren't waking up in the morning going, you know what, I want to breach this policy today. It's because the policy is far too complicated, too convoluted, and people just can't follow it. So again, rather than it being pushed down and us accepting it and trying to firefight and seeing how we comply, it's always that firefighting mode. We're going up the chain and saying we want a consultation on how to make this policy and procedure as effective as possible versus this is something we accept and have to work out. So you're right, yes, it's getting up the chain, making sure policies and standards are pragmatic. And again, another term that I use a lot with the second line and the third line is they have a whole raft of things to do. And what I say is I've got limited capacity. Everything isn't automated through RegTech and other types of technology just at the moment. So when I say yes to something, I'm saying no to something else. So I cannot say yes to everything. And when I keep pushing that back, I've got 10 items in my capacity. You want to put one in? I'm already at 10. You want to put one in? What's coming out? And that's a healthy dialogue to have with the second line.
Thanks, Sanjeev.
Simon, I'm conscious we've got one or two questions from the floor that we need to squeeze in, and I appreciate time's ticking. But I wondered if I could take a slightly more aggressive stance for a moment before we go to the relatively nice questions. So if we look at the failures that people like me see on a regular basis, because it's really a good thing when I walk through the doors of a bank, normally the biggest of them, I think, over the last few years has been associated with financial crime and financial crime related failings, which, if you're looking for acid tests, does the 3 lines of defense actually work? You could say that the evidence of large fines around financial crime is evidence it probably doesn't. So what do we think the causes of this are? Is it that this is a risk which we want the first line to own, but most of the controls naturally sit in the second line? Is it that it's a risk which people underestimate? Is it a poorly understood risk? Is it a risk which doesn't sit well in a 3 lines model? Clearly, we don't want to go into any specific instances, but you'll be aware of multiple failures. For example, very poor quality KYC, for example, is a very common theme. Huge backlogs of keeping KYC up to date. Failure to monitor international payments, for example, for sanctions breaches, a very common problem as well. And typically what people might describe as a poor culture of ownership of financial crime risks. I think all of these we see on an alarmingly regular basis. Why does the 3 lines of defense appear not to deal with those kind of problems? Or if it does, is it simply that there's some other factor which causes these problems to keep recurring? Perhaps I can pick on you, Jason, since you happen to be in the middle of my screen.
Yeah, I mean, I think the 3 lines of defense help solve things like, the financial crime issue. If you look at, before we had 3 lines of defense, we had our crusty relationship bankers that, like to talk to their clients, like to have lunch with them, but they saw the KYC as something that someone in sort of operations or trade support or something did for them. They didn't really take ownership for their business on that sort of front to back basis. And I think, a lot of these financial crime hiccups and events have really prompted a massive uplift in an eye opener for those relationship bankers in terms of what the expectations of the firm, the regulators, the stakeholders are in terms of their role in that process. So I think it's actually in those instances, I mean, there's been hiccups in the past, but I think the 3 lines of defense has made it very clear to a lot of bankers in the last couple of firms that I've been in that the world's changed and it's not just owning the client relationship. They are fully responsible for ensuring that the firm has all of the relevant information that enables them to make an assessment on the financial crime or the KYC aspects and whether or not they're suitable to be doing business with on an upfront and also on an ongoing basis. So I think ultimately it's help in areas like that.
Thanks, Jason. In the interest of time, we've got some questions from the audience, so I'd just like to change gears and bring some of those into the equation, because we have 5 or 6 minutes left. And this one is almost a follow-up really to that response, Jason. And the question is regulation, i.e. detailed rules, the correct starting point, or is it more appropriately the consideration of risk, harm, accidents, loss, threats, all the things that regulators might respond to with new rules that we should be focusing on? David, a perspective.
Thank you for giving me the hard one. Again, it really does vary globally. And I think if you look around, say, US, European regulation, there's a fairly prescriptive approach by which that regulation gets cascaded. There's clarity, a combination of white papers, industry feedback, etc. And there's a very clear process by which a piece of regulation actually formally gets enacted. I think as you move into some other jurisdictions, particularly some of the emerging markets, the formalization of that becomes potentially looser and less prescriptive. And I think certainly the room for interpretation in some of the regulations in some of those markets does potentially lead to misinterpretation or regulatory risk. I do think, from a personal perspective, I generally believe that clarity is beneficial. And I think, quite simply, when we come back to that cycle of rules, regulations, determining policies, procedures, etc., having clarity to codify what you actually need to detect and how you go about detecting it to ensure compliance allows you to get to that point of automation, which allows you then to, again, focus your resources on the prevention aspect as opposed to the detection. So I do think I've kind of sat on the fence on this question, so apologies, but the reality is I think clarity from a personal perspective is absolutely preferable. But obviously recognize that in certain jurisdictions that clarity may be more difficult to provide.
Thanks, David. Next question from the floor, and this is for Christian. The first line tries to preempt the challenge from the second line, where the first line uplifts its capability by establishing line 1.5 or 1B to self-challenge. Is this a good model to observe as an organization? Your perspective, your experience, please, Christian.
Okay, in terms of preempting the challenge, I mean, I'm personally supportive of the 1.5 line, that the 1B line being that's kind of where I've been focused for some time. I mean, it's a very fine line that we tread, I think. It's almost, I think of it a lot as balancing control and commerciality. I think that, there should be a natural friction between the first line and the second line, that the 1B line, if you like, seeks to mediate between. So I feel that in that respect, it is the right balance. The point is that I guess that the 1B does have to have teeth. It has to be seen to be challenging, the 1A function, but also serve that sort of triage role whereby, I guess first line needs to have the information, has the accountability, but can't be bombarded with endless data to sift through. So I think and whether that's just like human effort or whether it's automation, I don't know, but I think there is a key role in making sure that really the 1A is managing by exception only, and then really getting the data that it has to see. And I think if you get that balance right, then whether it is preempting the challenge from the second line, or whether it's just sort of getting its house in order as a starting point, I don't know. But for me, that's really the ideal working model. We've talked enough about independence already, but for me, that's the right balance. And at that point, you've got the blend of expertise where it belongs, but challenge where it's needed.
Thank you, Christian. Maurice, we have 1 minute left, sir. You've heard the debate. This has been something you've said that it's been out there since 2014 in the forums that you've run. The conversation you've heard today and the initiative. Any closing comments in the 1 minute we have?
Well, I think I think over the last 2 days, very interesting that the thing I'm taking away from this is aligned to this, the parallel conversations are clearly saying that first line governance and controls and approach towards conduct seems to have reached what I'd say almost like a steady state across the industry, with overwhelmingly the majority of the banks having invested so much into this. And I think we're now at a point of reflection where there's time and potentially resources to think, so what next? And what I mean by that is, I feel as if the obligations set by the regulators about the 3 lines of defense, and particularly around the first line, are in relatively good order. But the unforeseen consequence of the 3 lines of defense and the interpretation of it has led to this continual debate around first and second line. And I think that it's very important that this initiative across the first line that we and FTI are undertaking is not the first line's intent to address accountability, dilute accountability, to remove responsibility. It's simply to actually remove duplication, to make the process more efficient, to actually to work more cohesively towards the common goal of having a more robust, reliable, and cost-efficient approach to controls and conduct. And I think alongside this, what's going to be interesting is that I also have a feeling that the approach to surveillance and surveillance technologies are potentially being leapfrogged by evolving technologies around behavioral analytics and how those can be used as well to identify not just poor behavior, but also good behavior, which will help the case in relation to the commercial case for investment in controls and conduct and culture. I think the single thing is that we as a community, and particularly now with working with FTI, that I'm confident that we can now actually take this and actually make some adjustments. We do actually have a line into the communication with the FCA. They've recognized or seem to recognize the critical role of the COO and the first line controls officer. And we are looking to actually present our findings and the evolving approach to principles to the first line to the FCA. So even if we can move the dial fractionally, I think that could be the first step that could lead to some significant change. So if we can do that, then I think collectively we've achieved something to the benefit of the whole industry. That's what I'm going to say anyway. No. And unfortunately, we don't have time for anyone to say whether I'm right or wrong. So thank you very much for your contributions from across Asia. Jason, you're far nearer to a bear than we are. We will be talking to you. We're doing ongoing. We will be re-engaging you. For those in the audience, thank you very much indeed for your questions, your insights. We're doing the same this afternoon. If you want to attend this afternoon session with looking at a US focus, let's see where there's commonalities in purpose, what we're trying to address. Day 3, we've got a few more to go.